it's probably done. My view is the bottom is in markets, and the bottom was in crypto in June, and for Bitcoin was in October, November. The bottom was in for the stock markets in October, as most end of bear markets happen. It priced in a recession, and we move forwards from here. And eventually they'll cut rates again. And if you think about it, is we had a total shutdown of the global economy, then a reopening of the global economy. That's caused this inflation that's hurt everybody. And eventually we'll just rebalance back to some form of normality. There's a massive amount of doom porn about inflation is going to be structurally here forever. We're all going to die, which is kind of, I'm more like you are with the AI side, where I'm actually like, you know what? We've just developed AI. We've got relentless technology. The price of energy is coming lower from all different sources. Productivity of humanity is growing. So I think it's actually probably an interesting time. It's an interesting time because everybody's so bearish. Psychology plays a huge part in markets because everybody expects inflation to be relentless and ongoing and for the rest of our lives, much like what 24 months ago everyone was like, every tech stock's going up forever and every business can never fail again. You know, we're humans, right? We make forecasting errors of quite wide amounts at various points. So yes, no, I'm not just saying this because I'm just chatting to you. I mean, I do an enormous amount of work on this. I write 150 pages of research. I sit down and write it every month. I've been doing that for 19 years. And so that comes with 2,000 charts and models and stuff with myself and my colleague Julian Bittle, from secular themes, short-term themes. Doesn't mean I'm not wrong as well. I can clearly be wrong, but I just think it's in the price. And the worst part of it is the stock market's going to be going up probably. It won't rocket up at first, but eventually it'll pick up while we're all feeling the pain. The thing that leads it the most is the Chinese credit cycle. Who knew? But it is right now 17 months ahead. So when it turned up 17 months ago, we're starting to say, okay, there's something happening here. It also forecasts the recession. And then you've got other forward-looking indicators about 9 months out. We've got a bunch of indicators. But the last thing in the stack is rents. And the one before that is wages. So wages are going up right this now, but they take a while and then they start coming down again. They won't deflate. Nobody's going to really come to you and force you to take a pay cut, but it means that they don't keep going up. But your rents will probably come down. And so that's a function of these things just take time. The unemployment rise hasn't even started. Now, we can see everybody laying off. Every company is laying off people, thinking about tightening costs. Everyone can see it from sponsorship, advertising, sales. I mean, it's everywhere. I mean, every single person I speak to is like, Christ, it's miserable out there. But the unemployment side doesn't really come until it should start in the next month or two. And then that goes on for 9 months of just relentlessly higher unemployment rates. So anybody watching this...
Why is that so predictable? Why 9 months?
It's just how it always is, because companies make decisions, and whether it's around board meetings, however it's done, they get to a certain point where they hit the panic button and they lay people off. That's usually when the bottom of the recession starts. It's usually when rates start getting cut. It's usually when the stock market often recovers as well. So for people watching this, there's two parts of this. One is, if you're an investor, you might be able to buy these technology stocks with this renaissance of amazing changes happening around us at prices down 70% from where they were 2 years ago, a year ago. Okay, that's kind of interesting because your expected future return goes up. Same with crypto. You know, you and I have talked about this. You buy when the business cycle brings it back to the bottom of the secular uptrend. That's where we are. These are where you make all the money. This is what you get paid for, to take risk here. You don't get paid to take risk at the top, and you tend to lose money. So these are the moments in time. So that's very interesting as an investor. But anybody watching this, think about your cash flows. Think about your cash flow. Think about your expenditure. and just say, just be a little bit careful, because losing a job or having your own business struggling for a period of time, and I think the worst of it will be over relatively fast, but yeah, it's these laggy
Ballpark
effects.
me, what's relatively fast?
So I
So
think
if
the
we're
bottom of
recording this in March of 23, when do we think this turns around?
So I think the bottom of the economic cycle is in the next quarter. So I think we've got a really ugly quarter to come. But the problem is, it's that shock that sets off the companies to go, I need to lay off some staff, all of that. And it's that process that begins the healing. So
and
the
what
worst
is
of it,
that shock? So if that shock isn't people getting laid off, what is the shock that's coming in the next quarter?
the shock coming in the next quarter is the general slowdown from interest rates, biting into all of these indebted companies or households or credit cards and all of this stuff. And everybody goes, I'm not going to spend money. That is what a recession is. It's not usually driven by a pandemic. It's not usually driven by the entire financial system collapsing. It's usually by all of us making a rational decision of, I'm just not going to spend money right now because things are a bit uncertain. And that is what causes recessions. And I'm actually telling people to do exactly that because it's the rational thing to do. What you do, if you're going to panic early. And I'm not talking about the stock market going down either. I think we've had that. It went down. The NASDAQ went down 38%. That's pretty much bang in line with a regular bear market. But what I'm saying is in your personal life, where it really matters, where the rubber hits the road, is panic early. Just look at your expenditure, look at your cost, look at your business. So what do I need to do here just to make sure that I can just get through a pretty shitty year? But 2024, probably pretty decent. Interest rates have gone up, so people are going to buy less houses. Yes. Will house prices come down? Yes, because they went up a lot. Will the activity in the housing market dry up for maybe 2 years? Yeah, most likely. Are we going to see a leverage crash? No, because nobody's really got a lot of leverage at household level in property. That was something that happened in 2008. It's been too expensive and too difficult to do. So I think the home builders have a bit of trouble because they got a lot of inventory. They can't sell it. They need to finance it for a couple of years. It sits around 1990, 91, 92 was very similar. I was in London then. It was pretty shitty in the property market. It was great for me because I just entered the property market at the end of that. So prices were relatively low. They hadn't come down a lot, but they hadn't gone up a lot. And my income was going up because I was in my 20s. So your income goes up every year because you're hopefully getting promoted and stuff like that. So, but, a few property developers went bust. Things were slow. And then eventually it cleaned up. So I'm more of that opinion that, house prices come off 10%, maybe even 15%. Some areas that were really hot come down a bit further, but it doesn't expose any catastrophic leverage. The banking system is more than adequately compensated with capital. It's hugely sold in the United States. So it's just a bad time. It's just a bad time.
What do you think about rates? Are they going to continue to go up? Is there... Because the Fed, as far as I know, is signaling that they are going to keep taking rates up.
Yeah, so every single forward-looking indicator that I have on inflation suggests that inflation utterly collapses. If you want to see a real-time inflation data, look at something called Truflation, TRU-flation. It's actually on blockchain. It takes hundreds of thousands of individual prices on a real-time basis. And it tells you where inflation is today. And US inflation today is about 4.74%.
Wow.
Versus the headline, which says 6. So, and if we think of what inflation is the year-on-year comparison. What happened last year? Well, between March and June was Russia invading Ukraine and every commodity going through the roof. So we're going to see the flip side of that. So we will see inflation come off very fast. All my forward-looking indicators that look at it from different angles all suggest the same. So I think the Fed is speaking max aggression because they want to make sure that out of the embers doesn't rise the phoenix again. So they just want to stamp out people's expectations of higher prices in the future. They know there's a recession coming. They can see the inflation's coming. So that recession's coming. So I think it's the final game, which is like get down and stay down. And then that's what they've done. And so my guess is we'll be having this conversation in September, September, somewhere between September and December, and they'll have cut rates higher for longer. But if unemployment is going to rise, they have two mandates: inflation and unemployment. Inflation is going to be falling and unemployment rising. They cannot go to Congress and say, oh, yeah, we're just going to do this a bit longer. They're just going to fire them all. There is politics involved in the end. So, no, they will cut rates. And they should do by then, for sure. My mind hasn't changed whatsoever. And if I go back to the point I made before, crypto is priced by two things: the technological adoption curve, which is exponential. So you need to put a logarithmic chart. If you put a nice little logarithmic chart at the bottom of the log channel, so we've got to the bottom, and it's driven the ups and downs, these crazy ups and downs that look crazy until you put them on a log chart and they just look normal. Those crazy up and down are driven by the money supply, the liquidity cycle, the business cycle. And so here we are on the secular trend, and the business cycle is turning up and prices are down quite a lot. This gives you the highest probability of that.